What's up, YouTube? It's Joe Catchpolia, sitting on the couch, making some money, investing in fractional real estate online, as usual. Today we have a new Mogul property. That's why I'm wearing the Mogul hat. I think if you watch the channel long enough, you've figured that out by now. I wanted to mention it today because I've been thinking about merch, because YouTube is finally, I know I mentioned this quite a while ago, but then they never did it, but they're finally turning on the thing where I can have a little merch store on my YouTube channel. So I think I'm going to do that. I'm going to make some couch money hats, some stuff like that. And probably once I get that worked out, I'll do a little giveaway or something. I don't know. I thought that was fun and exciting news for me anyway. Maybe not so much for everybody else. So Mogul had a new VIP launch. It is a Padsplit in Marietta, Georgia. I think this is the Rojas. I mean, maybe I say it that way because I'm in San Antonio, and maybe somewhere else that's the Rojas. I don't know. I'm going to say Rojas. I'm going to assume that's what that is. Again, I have no idea what this name is in reference to. I really have a bad record of knowing what they're talking, how they pick their names. But anyway, it's an 8-bedroom, 3-bathroom, Padsplit. Looks very much like a regular house that they've added some extra bathrooms to. Beds and baths to. I think that's often a good thing when we think about resale, if we had to do it as something else. If we couldn't use it as a Padsplit any longer. But their numbers on this one a little bit disappointing compared to their average. Their average deal has a higher, average yield over the hold period. Usually we're seeing 14, maybe sometimes even 15 here. Levered IRRs often getting into the 14s or 15s. So, it's a little bit on the low side as far as that goes. But I still want to go through the full due diligence, because I think in a portfolio like this, I'm much more concerned about the downside risk of a property than I am exactly what those returns are, right? I'll take a 12, a 13, a 14, a 15. They're projections, and so there's a reasonable chance that they'll outperform on some and underperform on others. And what I'm trying to avoid with my due diligence is the big losses, right? And so that's why, that's what I'm focused on. I'm not terribly concerned with the slightly lower numbers, although it is something to note. They did mention the T12 income is above the first year underwriting. They do this quite a bit. Meaning that there's already in place income that's higher than what they're projecting. I think part of it, though, may be because there's some vacancy right now. Let me talk. I think this might be the first one in Marietta, Georgia. This is just a sub-market of Atlanta, but I figured I'd pull up the market, the population trends here. You can see it's a very small, relatively small city, 63,000 people. Between the 2000 and 2010 timeline, we did see a little bit of a decline, but every other decades, other than that, going back very far, it's just been growing. I like that trend, but much more, I like, the trend in Atlanta overall. This is the Atlanta metropolitan statistical area, and you can just see, we've just had fantastic growth. This is why it's a market that I'm excited to be in. It's also why it's a market that they need affordable housing. You can imagine with population growth like this, it's not easy to keep up with housing. And so something like a Padsplit strategy makes a lot of sense. Here's the property. As usual, I think it makes a lot of sense for you to open up every single one of these pictures in its own, in its full view, because then you get to see the stuff that's cut off on the edges. Look pretty nice to me, though. I didn't really see anything to complain about. Before I forget, please like and subscribe. In the description to this video, I have links to all the places where I'm currently investing in fractional real estate online, including Mogul, and some of them say they give you some money, and they don't. Some of them actually do. Most of them do. Moguls, I've gotten their referral fee when I signed up. But I want you to do, at least they did for me, right? And my point of this is I want you to do your own due diligence on the companies, on the links, in any of the properties, right? Just because I look through the pictures and say, hey, I didn't notice anything to complain about, doesn't mean that you shouldn't do that yourself, right? I'm doing these videos more to give you the ideas of things that I'm looking for, not as a replacement for you to do your own due diligence. You really want to dig into these things yourself. think about it from your own perspective. I'm just one guy sitting on a couch. I could miss stuff quite a bit. I've often other people in our Discord catch stuff, which reminds me, in the description to this video, there's also a link to the Discord I have set up. There's very lively discussions in the Mogul thread every time we have new properties. Ike saves me a bunch of time. A lot of times I post in links to all the things that I'm putting up here, or a lot of them. So does Brad. He's always sharing some info. We had some new people on the last one. I think his name was Mike, jumped in, shared some comp info. This is really what I'm here for, right? I love that we're starting to have a community, that we're getting different perspectives on these properties. Sometimes we've had people in a certain market that's looked at, been able to drive by deals and stuff like that, and that's really helpful. Anyway, that's my aside for today. Jumping back into the property itself. Okay, 8 bedrooms, 3 bathrooms, 1,380 square feet. That seems tiny for 8 bedrooms, right? Well, we've run into this before in this area, and I think what it is the below grade square footage, and this is the public records here. The below grade square footage doesn't show up as square footage here. Yeah, so okay, you see 1,380, but then they say, okay, we have a rec room that's 783. I believe that, and it's not really even below grade, like if you look at it, but it's below, so I think this area here, right? So this is the 1,380 square feet, and then probably this space right here next to the garage is the additional 783, where they've built the extra beds and baths, is my assumption. I don't know that for sure. This is saying it's only a 3-bedroom, 2-bathroom home, 2-car basement garage. So they're calling that the basement. So that leads me to believe this is the square footage, in the quote-unquote basement. It just doesn't look like a basement to me, right? It's above ground. Maybe on the back side it's not. I don't think so, though. It doesn't look like that much of a slope. Anyway, it is one of the things that when I've asked Mogul about this, they say, they always look into, was this properly permitted when they did the work to convert it to the extra beds and baths? So even if it's not reflected in the public records, I know that's part of their due diligence checklist. I've stopped checking on that because so far they haven't given me any reason not to trust them. I feel like they make a lot of the right decisions. They think about real estate a lot, very similar to how I do. And so I've just taken their word for certain things. Doesn't mean that you should. If you have questions about this sort of thing, definitely ask. But I think that's what's going on here, right? I mean, you're not squeezing 8 bedrooms into 1,380 square feet. You've got some in this lower level here. Okay. Let's see. What else were we going to say about this? Oh, so one of the things, let's see, the year 1 yield, right? Which I do always hate when we get these emails. Oh, actually though, they do tell us year 1 yield, so this is good. It's when we're actually looking at this page that we're getting just the average yield here. But you can put your little cursor here and always see what the year 1 yield is, and so 9.2. Where is this lower IRR coming from, right? How is it lower than our average yield? Well, I think it's here, right? Where we have a 2% appreciation, which is one of the lowest assumptions I've seen them make. I'm not exactly sure why they decided on that for this particular neighborhood and property. I know they're doing a lot of research into this stuff, and obviously they can only share so much data. So that's one thing. I don't think like the average yield is a little bit lower, but the IRR I think is even more so because of this lower appreciation number. Let's see, what else would I? But I always like to shut this off too and see, okay, how much is the refinance actually affecting us? Ooh, it's actually a big number this time, right? We're getting down to 11 and 12.7. 11 IRR, 12.7. So moving about a whole percentage point on each one. That's interesting. Let's turn the refinance back on. One of the things I wanted to mention, they're still using this 6.875 assumption, but they mentioned on their webinar that they are actually getting quoted lower than this now. So I think there's a decent chance that this loan will come in lower than this amount. Not sure that that's the case, but if it did, wonder how, if we can, 6 point, what if we, oh, can we change this? Oh, we can change this. What does that do? I'm super curious. I haven't changed that before. It doesn't move it a whole lot, but gets your average yield into the 14. Let me just refresh this. I think it'll put it back. Hopefully so. Yeah, brings it back to their default assumptions. So anyway, not a terrible yield, but it is lower than their average, right? And I've been pretty picky with them lately. One, because I just want to see how the portfolio that I've already picked up, how it performs, and I've been sharing my updates with that. But also, too, they're just relatively new, and I want to see, are the assumptions that I'm making relative to their, to their projections accurate? And also, next year, they should have a secondary market out, and understanding how that rollout goes, it might change the way I invest on the platform quite a bit. If it's like, ARC 7 or Arrived or Lofty, where the stuff that trades on the secondary market ends up being a big discount, that's probably where I'll start picking more up. If they're able to structure it in such a way that that's not the case, which seems to be what they've hinted at, right? That they have some thoughts on how to make that work a little bit differently. Then of course I'll just keep buying, because I'm perfectly happy with the deals as presented. But I think it's possible I'll be able to pick them up, some of these next year at a discount. I think it's also possible that we might be able to pick them up next year without a real discount, but with a whole year of operating history, right? And that one of the things that I've noticed over and over again in the fractional real estate space is there's a lot of people investing in this that then just need their money back for some reason, right? That, okay, it was supposed to be a long-term investment, but they just need to get it out. And so that's why they're fire sailing 2 or 3 or 4 years into these investments. And we're getting these fantastic discounts. So I think there's the possibility for that. But overall, I still like I think their average deals are perfectly fine. I would challenge you, go out in your market, find a deal where you're getting a 9.2% cash on cash return in year one, and over your hold period, bumping that up to 13%. It's not easy to do, right? So, sometimes I start to take it for granted because they are just able to continually pump out those deals. That when you see one that's a little bit below their average, it's like, okay, well, that's still those numbers aren't terrible. I'd be pretty happy with that. Compared to a lot of other, compare these numbers to Arrived or to Real Bricks, or to your average actual returns on Lofty, and you're just destroying all those platforms if they can, stick with their projections here. So that's why this is still the platform that I'm most excited about as far as for long-term holds. Let's see. Let's start closing some windows here so I'm getting less confused. Oh, I want to mention a couple things in the contract. They do have an appraisal contingency, so that'll be important. We'll talk about value in a little bit. They mentioned here the seller will make every attempt to book all rooms to the best of her ability. Seller agrees to change the Padsplit dashboard within 24 hours of the binding agreement date to include no move-in fees and reduce room rates to help increase the current occupancy. We'll continue to work with Padsplit to make all efforts to get the rooms booked as soon as possible. So where's that coming from? Why are, some of them have actually said they will be full at closing. They haven't said that here. Well, if we look at the Padsplit listing, and again, thanks Ike for finding this, there's 4 rooms available. We have 4 out of 8 rooms available right now. So that's a lot of turnover happening at this point in time. I have no idea if that's what it's looked like historically, because when they do their projections, they're basing it on, they said, okay, we're doing better than our trailing 12 numbers. Well, those trailing 12 numbers have vacancy built in, right? Unless they just had a magical perfect year, they already have vacancy in those numbers. So that's why you don't see a separate vacancy line item, because they're already just using the average of the previous operations as sort of their benchmark. And so that's already accounting for some vacancy. Now, 4 out of 8 seems like it is more vacancy than I would expect to have at any given time. So I'm curious if there's something going on. It might also be why the seller decided to sell right now, right? Like if I'm having a problem with occupancy, that's when I'm going to sell. So I don't know. I'm not really sure what's happening there. But it was interesting to see this language being a little bit less strong where, it's best efforts and these are the things that they're actually doing. So that worries me a little bit on the occupancy front. Couple other things I'm going to go into some of the easy stuff and then jump back into valuation. And so, okay, looked up the flood map. Looks like we are squarely in an AE zone. This is not where I want to be. So if you've watched my channel for a while, I try to not be in a shaded zone at all. I have decided that I'd invest in some of the shaded X zones, which are a little bit worse than a regular X, or which are worse than a regular X. If I like everything else about the deal, so I bought into a few properties on a couple of different fractional platforms where I have been in the shaded X zone. But the zone AE, I just don't, there's just so many opportunities to buy good deals. I don't know why I would buy one in a flood zone. One, you're going to have flood insurance. I'm sure that this is something that the guys at Mogul have thought about. They're very good about, they seem to be pretty savvy on insurance and understanding what they need to do and whatnot. And that's part of the reason why I bought some in the shaded X. One of the other ones that they did. But at the same time, I think it really hurts your resale value. And maybe that's part of why they're saying, okay, 0.2% appreciation rate instead of higher. I think that sort of thing is something that I'd normally take into account. Maybe that's what's going on here. But just because I have the opportunity to buy a Mogul Padsplit in the greater Atlanta market, that's not in a flood zone, I don't know why I would choose this one to invest in, right? Unless there was some other reason that made this real exciting for me. But so far I haven't seen it. So that's the flood zone. This is one of the best crime maps I've seen. So this is the spot crime map. And a lot of times it'll generate a map like this with only a couple weeks of crime. But this is going all the way back to June, I think. Yeah. So it's one of the best spot crime maps that I've seen, so I was excited to see that. So if crime is one of the bigger things you're concerned about, that might be a reason to pick an area like this where, okay, maybe some of the other things aren't perfect for you. Looking on the, this is the neighborhood scout map because I wanted to get another one. When I saw how good that spot crime map looked, it made me a little nervous, right? It was like, okay, are they just not reporting everything? Well, I don't think so. It is one of the lightest shading areas. So it's this section right here. I believe, below 360. It's this section here. And, it looks like it's very far towards the safest side of the shading spectrum. So I thought that's really good. I saw that before I saw the flood zone stuff. And so I was thinking that I might want to jump into this because most of the pad splits that we've seen have had kind of rough crime maps. So it was nice to see one where that wasn't the case. Parking for this is great. That's one of the things we're looking for all the time. They've got, some spaces here, but then also have some crushed rock and, additional spaces there. In the pad split listing, I think they have 4 rooms, and I think they also have 4+ open parking spaces remaining. So this is really good from a parking perspective, right? It is a very, let's see, do I have it on this other map? No, I don't. It is a very good size lot when you look at it from above. Like, this is where that extra parking is, and so I don't know. You can see it goes kind of far back. So even if you wanted to add additional parking, I think you could. Always a big concern, especially because when I looked at this, I could not find the nearest bus stop. And I don't know. I had that come up on one of the other ones, and it made me wonder. Is it just Is it just that it's not showing on these maps anymore? But I wouldn't expect the bus to be anywhere deep into a neighborhood like this anyway. So yeah, I think probably a lot of the people that are staying here are going to be car owners, and so having that parking is really important. What else did I want to? Was there much else on this map I wanted to talk about? I don't think so. I mean, it sort of in line with the fact that it was the neighborhood looked real nice, or the crime map looked real nice. I mean, I think it's when you do this little walk around the neighborhood. There were very few signs of. I didn't see any graffiti. I didn't notice any like broken down cars just sitting on the side of the road, or everything looks like it's in pretty nice shape. I didn't notice any like dilapidated or abandoned houses, and so. All that kind of stuff is the stuff I'm looking at or looking for. So I actually really like this one from that perspective, right? Just the property itself. If we had to stop using this as a pad split and just sell it as a single family home, I think we're going to do all right with it. And let's get into the valuation here. So as I mentioned, we do have an appraisal contingency. We've seen a couple times now, though, that doesn't always mean if it doesn't appraise, we're not going to move forward, right? We saw them adjust the financing a little bit to keep at least as good of an IRR, and then they still move forward with the deal. But so, okay, 364.9. I didn't actually look up their specific comps, just because when I started to look at the third-party sites, they seem to corroborate it pretty well. Zillow was the one that was a little low, 334. Realtor actually didn't give me a price estimate for some reason. In some markets, it doesn't seem to like to do that, and I don't know why. But Redfin was right on the money, right? 365, 775. You can see, yeah, they still have it listed as a 4-bedroom, 3-bathroom. So they at least know how many bathrooms there are. They're short on bedrooms here. And then Homes.com, puts it right in the range there, which, 345 to 373. So I feel pretty good about this price that we're paying, right? The 364, especially again, because we're getting the operating business, we're getting all the furniture, the fixtures, equipment, like everything that's making it a pad split. But also too, like Redfin just says, okay, that's right on the money. We got the appraisal contingency. I feel good about it. I didn't decide to dig into these comps, any further. Oh, where are they? Any further than what they? I'm looking at the wrong ones. Than what they provided. But I also think this is probably a tough one because, like, do these ones have an extra 700 square feet, in the basement? Maybe they do. Maybe they don't. I guess that'd be a reason to sort of dig into this a little bit more and figure out. But I just didn't do it today. It's something that, I had already decided I'm not going to buy into this one. One, the lower than average numbers I don't love. Again, it wouldn't be the end of the world if I liked everything else. But the flood zone for me, the AE flood zone, it's really, I just don't like it. I'm not interested in investing in that. I already have quite a few of Mogul's pad splits, especially in the Atlanta, Georgia market. So even though this is a sub market that I don't have exposure to yet, it just I'd have to be really excited to want to pick something more up here, and that's sort of where I stand on this one. Let me just make sure there's not anything else that I wanted to tell you about. It's going to be pretty quick today, keeping it nice and short. I didn't talk a lot about the market, but that's because we've talked about that market quite a bit. Didn't really, the third-party sites made the valuation seem okay, so it didn't really jump into those comps. But again, if anybody does that and you share it in the Discord, I really appreciate it whenever we're having that discussion in there and everybody, people are doing some work and helping each other out. That's where the value of this community really starts to shine, is when we're doing that. And then, as far as their numbers, they're based off of their T12, so didn't really look too, didn't do a calculation on their projections. But it is, one of the things, reasons I already mentioned, though. Okay, the flood issue, the lower than average numbers, but then also too, 4 rooms available out of 8 just really makes me nervous. Like, is there some reason that's happening? It's possible it's just seasonal. It's possible it's just a coincidence. It's, maybe they just waited until there was a bunch of empty rooms for them to go ahead and list it, because that makes it easier. If they're going to do showings, or, there's not as many members in the home that you're going to annoy. I don't know. For all those reasons, though, I'm passing on this. I'm curious, are you buying into this? If so, let me know in the comments why. Is there something that I'm missing, right? Is there a reason to be excited about the upside on this? And I think, Mogul, they're usually pretty good about telling us why we might want to. They are saying, okay, the immediate value add is via professional management, meaning the seller must be self-managing using Padsplit versus using a professional manager with Padsplit. I think that can go both ways. Sometimes you get these self-managing individuals who just crush it. You see this a lot in short-term rentals as well, right? Where you have like just these individuals, they have 1 or 2 properties and they just have amazing reviews and do really well. I've got a couple clients here in this market that are like that. They just have a couple of homes, but those homes are doing amazingly well. That they run themselves. And sometimes you see management companies that are able to come in and bring the average mom and pop deal up. And sometimes you'd see management companies that can't perform as well as your mom and pops, but obviously Mogul has a relationship with a manager in that market already who's running most of their properties. And so they have a good idea, of how, or, probably all their properties in that market. So they have a good idea of how they expect them to perform. So yeah, I think that's a potential for an upside, but it's not really enough for me to want to jump on it. I mean, I do like that it seems like it's priced well. It doesn't seem like we're paying up at all for some extra revenue like we are in some of the other ones. But that's just not enough to get me over it. So yeah, if you, either way, if you are going to buy it or not, let me know, and let me know why. Because I do, always looking for additional insight into these deals that we can share. Anyway, that's it for me for today. I can tell I always get a little rambly at the end. Yeah, I'm sure you can tell I'm just super tired still lately. Gonna get back on track soon. I believe that. I know I keep telling you that, but I think that we'll get to a point where we'll start having like a little bit more clear and concise endings to these videos instead of this. But that's what you got for me for today. So until next time, I'm gonna keep making mistakes so that you don't have to.